This is Dr.T Varalakshmi discussing you about the definitions and terminology under the Unit 2, that is Production and Cost Analysis of Business Economics and Financial Analysis. The Unit 2 product is more concentrates on the once the demand is finalized for the product, then how to apply the economic concepts on while producing that particular demand identified product. So that is, and as well as the how to fix the price based on the cost involved in that particular product. So it is the concepts discussed under this unit 2 is production function. So that as well as isoquants, isocosts, marginal rate of the technical substitutes, least cost combination of these inputs, various productional functions, and especially the Cobb-Douglas production function, internal and external economies of scale, and cost analysis. In this break-even analysis and determination of the break-even point with the simple problems and managerial significance of the cost analysis. These are all the concepts that we have discussed under this unit 2. Let us see the terminology in this unit 2. That is, define production. So production is an activity of converting the inputs to the expected output, which means the relationship which reveals the maximum amount of output capable of being produced by each and every set of the inputs. So generally, the raw material, labor, technology, land, etc. will be called as the inputs for any product. With that inputs, what is the level of their output and how to get that one? So that is the conversion of the inputs to the output procedure is called as the production. Here we will get a concept of isoquants. So which means iso means equal, quants means quantities. Here isoquants will indicate about the equal output levels for the given various combination of the input combinations. So for example, there is a labor and capital is going to be using as an input to get the maximum output of 100 products which they have produced. So here 10 labor plus 1 lakh capital might gives the 100 products, means the 80 labor plus 1.5 lakhs of the capital may give the same level of the output, and 60 level of the 60 labor and 2 lakhs worth of the capital, that is with that capital they might have purchased the machinery, something extra addable or the replaceable to this particular labor, and it is going to be giving the same level of the output. Then that combination of the input levels, here we have taken the 2 variables, but we may take this 3 variables, multi-variables, but the different combination of the inputs, but they must give the same level of the output. That elements will be called as the isoquants. If we see the features of these isoquants, it is downward sloping curve and it is convex to the origin and it does not intersect at all, because it is going to be replacing with one variable with another variable, and it does not touch us to the axis because there is no chance of becoming zero of any of the input levels. That is the isoquants. Same as isoquants, there is a isocost. Here is also, this curve represents the combination of the inputs that will cost, that is expenditure incurring on that inputs must be the same. They may be various the different output, but the cost which is incurring on that one should be same. So if that occurs, then that curves will be called as isocost curves. So next thing is the definition of the cost. Cost is the expenditure incurring to produce a particular product or service. That is called as the cost. For anything, let us say to produce this particular markup pen. So for this one, they need to implement this labor charges, administrative charges, this material which is using for this one, machinery charges, that machinery keeping land charges, government taxations, administrative expenditures, everything. So that means everywhere they're spending some amount to get the output of this particular pen or this mechanism. So for that one, the amount which they have spent in getting of that particular production output is called as that cost. So various kinds of the costs are all there. Here, the marginal cost means, so the change in the aggregate level of the economy activity of the particular country or any productional activity is called as the marginal cost. That is change in the total cost divided by change in the quantity produced. For example, for producing of 10 products, assume that there is a cost incurred on that product is 100 rupees, and to produce that 12 products, so the cost which is incurred on that product might be 110 rupees. 110 rupees. So here, for this producing of these two quantities, there is an increase in the 10 rupees of cost. So which means on an average, 5 rupees of the marginal cost is there on the productional activities. That is called as the marginal cost. Next thing is the opportunity cost. So the next best level of the benefit or alternative foregone is called as the opportunity cost. For example, opportunity cost means return on the best option not chosen minus return on the option which we have chosen. Let us say in this pandemic situation, if you are going to the work, either you can choose two options, either work from home or going to the office. If organization has kept a condition of 100% salary for those who going to the work or to the work office, and 50% salaries those who opt this work from home. Let us say if you have chosen this one, that is work from home, you have left this one. The return on this option is 50,000 and the return on this option is 25,000, which means you are losing the opportunity of 25,000. So that is the opportunity cost. The next definition under terminology is what is the incremental cost? The cost which is incurred to enhance volume or quantity of the production from one level to another level. So from, let us say, for 100 products production, what is the cost? If they increase the next volume, that is if they have the demand, if they want to produce 150 products, then how much of cost they have to add? That expenditure which is added is called as the incremental cost. Next thing is sunk cost. So the cost which they have already incurred and cannot be recovered at all is called as the sunk cost. So, for example, they have spent $400 for the last year to replace the water pump, and $2 million spent 5 years ago on a new manufacturing plant, and $1 million spent on a research and development 2 years ago. So, whatever it has done, it cannot be undone, which means they can't get back that one, they can't recover that one. So if they want to, they can't stop the water pump. If they want to resell that water pump, they may not get the $400, they may get only $200. The remaining $200, it is not at all used. So that last thing is called as the sunk cost. Next, very important concept is break-even analysis. So it is a point of where no loss, no profit analysis, then that is called as the break-even analysis. So it is the analysis of costs and their possibility impact on revenue and volume of the firm, hence it is also called as cost volume analysis. So for example, the expenditure incurred on the product is 50 rupees and the products sold it for 50 rupees only, then we can say that cost is equals to the volume or the revenue which they have incurred. Here there is no loss, no gain. That point is called as the break-even point. Next thing is variable cost. The cost which varies with the level of the output, then it is called as the variable cost means. So which changes as per the number of inputs which are using in the product, then it is called as the variable cost. So for example, the raw material for a product is 1 kilo product. For 1 kilo products, 10 products are all producing means for 2 kilo products there is a chance of producing 20 products. So the cost which is incurring on this raw material will be varies as per the number of output. That cost will be called as the variable cost. But the land or the machinery which is amount spent on that machinery is same. Machinery is the same for the producing of 10 products or even for the producing of 20 products. So that is called as the fixed cost. The cost which changes as per the output but does not as per the time period, then it will be called as the variable cost. But if it changes as per the time period, but up to certain level of the output, if it is the same, then that cost will be called as the fixed cost. Next one is out of pocket cost. The unexpected expenditures which is incurred and by the people will be called as the out of pocket cost. So the direct payment of the money that may or may not be later reimbursed from a third party sources, then it will be called as the out of pocket cost. So most of the organizations will provide the medical insurance to these employees. If any organizations doesn't provide in this pandemic situations, it is better to go for this medical insurances by the people from their own onwards. Now the employees are going from their own expenditures for the medical insurances, then that expenditure by the employees will be called as out of pocket cost for him. That is the out of pocket expenditures. Next thing is the short run cost. The cost that is going to be estimating for a short run time period, that is within 1 year time period, then that will be called as the short run cost. That defines the minimum possible cost of production each output level when variable factors are employed in the cost minimizing process or the fashion. So that is called as the short run cost. The cost function that represents the minimum cost of the production, a quantity of some goods which is taking both variable and fixed elements into the considerations, then that will be called as the long run cost. So generally, if it is the business is newly established, they will more focus on the changing of the inputs than the changing of the fixed elements. Like same land they will use, but the level of outputs will be changes by increasing the labor, raw material, etc. If it is a long run, that is 2 to 3 years, again they'll focus on increasing the another plant, land, machineries, etc. So which means in the short run, more concentration on the variable elements. If it is a long run, more concentration on the all kinds of the elements. Next concept is what is profit. Profit is the financial benefit that is realized when the amount of revenue is gained from a business activity, and if it is exceeds the cost which is incurred on that one, then it will be called as the profit. So that means if a product price is 100 rupees and the expenditure which is incurred on that product is 50 rupees, then revenue or the income is 100 and cost is 50, so that the profit levels are all 50. So let us say the cost which is incurred on the product is 150 rupees, which means there is a loss of 50. So there is no chance that the organization will get a profit, and there is a chance of getting the losses too. So the total revenue decides the number of products which they have produced and the unit price of that particular product gives them the total revenue. So let us say product average selling price of the product is 10 rupees and the units of the output is 1000 articles, then the total revenue is 10,000 rupees. So that is the total revenue, that is receipt from the sale of a given quantity of goods or services. So these are all the terminologies, definitions and terminologies in this unit 2, production and productional function. Thank you.
Like, share and subscribe. Hit the bell icon for more updates.